Our EBITDA margin was at a healthy 23.2%, 110 bps lower year-on-year, despite the unprecedented inflation and step up in A&P investments. From a segment lens, Home Care continues its robust performance and grew 30%, led by high double-digit growth in both fabric wash and household care. Beauty and Personal Care grew ahead of the market at 17%, led by strong performance in premium portfolio across categories. Foods and Refreshment grew at 9%, led by stellar performance in ice cream. Margin across divisions remained healthy, with Home Care at 18%, BPC at 26%, and F&R at 16%. Despite high inflation, we continue to build our brands with new innovations and activations. We had quite a few launches in clean beauty and natural space, such as TRESemme's new hair care range, hair oil and mask by Love Beauty and Planet, and serums and masks by Indulekha. Lakme expanded its skincare portfolio with new facial foams and creams. Comfort has launched a new variant, Comfort Delicates. Talking about the operating environment, as you know, inflation has been a real challenge for the industry for the last few quarters. Several commodities have inflated to their decadal highs at the same time. Against that 10-year median price, Brent crude, caustic soda, polyethylene, barley have all seen inflation by more than 50%, and their prices are hovering at historical highs. Palm oil, which has seen more than 100% inflation, has softened from its peak recently. Further, with dollar strengthening, we are seeing currency-led inflation impacts. Consequently, this widespread inflation is impacting consumer demand. On a year-on-year basis, market growth is price-led and volumes have declined. Rural market continues to lag urban. Optically, year-on-year market growth in June quarter looks better than March quarter, but that is on a low base impacted by COVID. On a 3-year basis, volumes are flat, both in NQ and JQ, and market value growths are in mid-single digit. In this context, we continue to dynamically manage our business to grow our consumer franchise and protect our business model. We have been consistently winning shares in more than 75% of our business. Further, we have held our EBITDA margin at a very healthy 23.2%, a 110 bps decline despite increase in our cost of goods sold by 330 bps. Through our strong savings program and growth leverage, we have delivered a 270 bps reduction between other expenses and employee costs. Our A&P investments have increased by 70 bps year-on-year as we continue to invest at competitive levels and have ensured our share of voice is ahead of share of market. While we are navigating the short-term challenges with agility, we continue single-mindedly on our journey to create a purpose-led, future-fit HUL and deliver 4G growth that is consistent, competitive, profitable, and responsible. Talking about purpose, we have taken a big step in this quarter and announced our full suite of ESG commitments across our 3 pillars of planet, people, and society. These are specific time-bound actions that we're committing to in order to tackle the most critical challenges of our time. For example, we have a target to achieve zero emissions in our operations by 2030 and have committed to contribute 3 trillion liters of cumulative water potential to Hindustan Unilever Foundation by 2025. Details of all our commitments are available on our website and in our annual report. Now, before I turn to our outlook, it is important to understand that sequentially commodity markets have inflated further in June quarter, and most commodities are at very high levels. Net material inflation, or NMI, which is the net absolute inflation that our business faces after factoring in all savings and efficiencies, was at circa 20% in June quarter 22. Given that the correction in some commodities like palm happened in the last couple of weeks of June, we will have higher cost pipeline inventory that was contracted earlier. With consumption of this inventory in SQ and many other commodities like crude oil, caustic soda, and plastic remaining elevated year-on-year, SQ and MI will be higher than June quarter. Needless to say, we will continue to extensively drive savings in our business and take calibrated pricing actions. If the softening that we are lately seeing in commodities remain, we expect DQ and MI to be lower than September quarter. We would need to wait and watch how commodities play out in next few months to get a sense of the exact quantum of reduction. Let me summarize. We had a strong start to the year with 19% top line growth and 11% EPS growth. More than 75% of our business is winning share. Despite the unprecedented levels of inflation, our EBITDA margin remained healthy at 23.2%. Looking ahead in near term, growth will be price-led as inflation continues to impact consumption. As I mentioned, most commodities have further inflated in June quarter and continue to remain at very high levels. This, along with consumption of higher cost pipeline inventory, will result in our September quarter margins to remain under pressure. If the recent softening of commodity stays, it will positively impact our sequential margins from December quarter 22 onwards. Our two clear imperatives remain: grow our consumer franchise and protect our business model, number one. Number two, continue on our journey to create a purpose-led, future-fit HUL. We are focused to deliver 4G growth that is consistent, competitive, profitable, and responsible. With this, I complete my prepared remarks, and now we can take some questions.
Thank you, Ritesh. May I request Vinny Motiwala from ET Now to ask the first question, please?
Hi, good evening, everyone, and thank you so much for giving him this opportunity. So my first question is obviously going to be on the commodities front. You have mentioned that, commodity prices, yes, sequentially they're higher, but we are seeing them come down in the last couple of days, last 15 days, you could say. So now, is there a strategy where the company will be looking to roll back any price increase they've taken, or is there, as of now, any promotion you're looking to give as well? And also in terms of that, what is the outlook coming in on terms of margins? Is there a wait and watch in terms of margins before passing on any price cuts, or what is the strategy there?
Yeah, thanks, Vinny. There are 3-4 different perspectives. Let me capture them. As I mentioned in my commentary, June quarter, we have seen decadal high inflation across multiple commodities at the same time, be it crude, be it vegetable oils, or be it inorganics like caustic soda or barley and other commodities. So that is the reality as far as June quarter is concerned. And when I look ahead, September quarter, yes, recently palm as a commodity, it has come off from its peak, but there are several commodities which are still inflated. And including items like milk extract, barley I mentioned earlier, and coffee is inflating as we speak. Crude June quarter was at $110. As I speak, spot is at $106. So we are seeing inflation continuing across many commodities. As we have seen palm coming down as one of the commodities, we will have to see the totality of all commodities which impact inflation. Let's also remember at the same time, US dollar is strengthening. There are many commodities where feedstocks of that has impact of currency depreciation. We've seen last 3 months time, currency has depreciated by 5%. So every commodity which has input which is imported, or it trades at international port parity, will see impact of currencies also coming in. And there will always be an impact of inventory. At any point in time, business will operate anywhere between 4 weeks to 12 weeks of inventory, depending upon a material. And there will always be a lag impact of that, which P&L will see. The point that you mentioned, yes, we are seeing some commodities now coming off, like palm oil. And if that situation happens to more commodities in times to come, we do expect in December quarter, if that is true, for us to build back margins sequentially from December quarter onwards. As far as September quarter is concerned, there will be pressure of commodity and there will be pressure of margin. As a point that we have always maintained that whenever in such times, we will keep doing what we know best, which is keep driving savings very hard across the lines of the P&L, and with very clear objective of growing our consumer franchise and protecting the business model. And where required in particular category, we will take calibrated price increases.
Thank
Okay,
you, Vinny.
and
We'll come back to you, Vinny.
okay, sure.
Mangalam, would you like to ask the next question, please?
Yep. Well, thanks a lot for the opportunity. These are good numbers as far as the top line is concerned. Since you all have commented on the operating margin environment, I'd like to ask you about the demand itself. How do you see demand panning out? You have been saying that rural has lagged urban demand, but as we speak, the monsoons have been good. With the commodity prices hopefully stabilizing going forward, do you brace yourself for a stronger second half of this year? Can you comment on that?
Sanjiv, can you take
Yeah,
that?
let me, hi Mangalam. Let
Hi.
me take this question. Yeah, if we have to look at the volume growth, we're still talking about the market at about a negative kind of 5% in the last 3 months. And if you look at it from a MAT perspective, at a negative 4%. And whereas when you look at from a value perspective, as Ritesh said, in the last 3 months, it's about growing at 7% and on a MAT basis at about 5%. So it's a pretty muted, say the value growth. If I were to look at the pre-COVID period, yeah, is that's when, and over a 3-year period, it would still be higher than the value growth now. But what are the green shoots that are visible for us? Yeah. One is, of course, that if the trend of the tapering of commodity prices remain, then that's one good sign. Because it's not just about our products, it would mean the impact on the consumer would be much less. And they in turn would be able to spend more in our kind of categories. The second is, if we look at monsoon, I think on an average it has been decent, but still there are certain pockets like UP, etc., where the rainfall has been less than average, but assuming that because the forecast is that it should catch up, then that should also augur well. The third one I would say is, if the food prices remain more than the cost of input, and we should also understand that the government has taken a lot of steps. For instance, the fertilizer subsidy has gone up. And if that results in the net income of the farmer going up, then that should also augur well for the consumption. So it's going to still remain a volatile period, but we always look at green shoots and we remain confident that the market, as far as the volume growths are concerned, that should start to inch up if the conditions that I've described, they turn out in the manner in which I have portrayed.
And the margins, they get worse from here in the second quarter, or they will maintain at these levels because of the price hikes that you've taken?
See, Mangalam, first is, what Ritesh was alluding to, for instance, in the June quarter, our net material inflation was in the vicinity of 20%. Whereas our price growth has been about 12%. So our price growth has been lagging behind the net material inflation. And we try to optimize that by playing the different levers of difference. Yeah, is optimizing all of the costs that are there in the business. The other important point we must understand is the spot price is not what would be the impact in the books in the September quarter, because there is a pipeline of commodities and they would have been purchased at a higher price. And so it does not immediately impact the books. Similarly, even when the price increase happens in commodity, it does not immediately impact the books necessarily, depending on the quantum of stocks that you would be having. But when it comes to pricing, we do take the spot price into consideration because that gives us a kind of picture of what is there in the days ahead. So September quarter, the cost is going to be definitely more than what is there in the June quarter.
And finally, before I let you go, the foods and refreshments, that's the one business that grew at around 9.3% as against other businesses which have grown much faster. Is there any particular reason for that? Because the street was bracing for a better growth out there. It was summer. The ice cream business was supposed to do well too.
Yeah. See, first is ice cream business has done fabulously. There are certain factors we must understand. They are one of our big categories is the tea category. In the tea category, the price increase took place. The cost increase of tea, raw tea, went up in 2020. Then it went down, in fact. We have taken prices down of tea. If you were to look at the volume growth of foods and refreshments, it's at an average level of 6%. So foods and refreshment, the price increase has been significantly lower than the rest of the business. So the headline growth, that's the reason, one of the reasons is, that's the reason it's lower than the rest of the business. But the volume growth still remains very robust.
Thank you, Mangalam. Tessa, would you like to ask the next question?
Yes, hi. Hello, sir. Congratulations on a good set of numbers despite, inflationary pressures. So, just tell us, going forward, like, how is the consumption going to pan out in terms of, say, in the category wise? Like, is there any particular category that is likely to, get back to normal?
The first is we have a very wide portfolio. And you would have seen during the last couple of years how we have played the portfolio to our advantage. There was a period when we grew tea at a massive rate. Yeah, now is the time when we are playing home care at a very rapid pace. And even if we look at our beauty and personal care, it's growing at 17%. Whenever times are tough, the discretionary categories get more impacted. But within our portfolio, because premium part of the portfolio, where we are over-indexed to the market, is catering to consumers who are much more resilient, is even the growth remains much more resilient. Yeah. At the bottom of the pyramid, where people have much less disposable income to play with, there the stress is much more. And there we have been very circumspect when it comes to price increase in the price point packs. So we have been playing different levers of the business, keeping two imperatives very clearly in our mind. One is we have to grow our consumer franchise, which is growing our market shares. And as Ritesh alluded to, we've had a fabulous track record over the last 2 years of growing our market shares at an unprecedented pace. The second is, how do we protect the business model? When the costs go up to the extent that we have seen, it is of course not possible to ensure that the margins remain at a 25% level, but we have still ensured that the margins remain at a very healthy level. And those are the two imperatives that have driven us in the last 2 years.
All right. So, without
Tessa will come back to you.
All right. Okay.
Nupur from Z Business, would you like to ask the next question? Tessa, you can go ahead.
Thank you. So I was asking with regards to like out of home consumption, since that has accelerated pace, are you kind of like still aggressively focusing on the B2C and the e-commerce strategy, or are you looking at different ways moving forward?
That's a good question, Tessa. First is e-commerce is going to remain a secular trend. While the pace of growth may come down, is if you look at it over a long-term basis, the share of e-commerce is bound to go up. And today, more than 20% of our total demand is captured digitally. So that's a thrust which we are bound to. The second question, you're absolutely right, is with the opening up of the economy, with people stepping out, we have definitely seen modern trade bouncing back. And we are very cognizant of it. And as you are aware of it, our shares in modern trade are higher than in GT. So that is again playing to our advantage.
Okay. All right. Thank you, sir.
Thank you. Winnie, you had a follow-up question.
Hi. Yes, sir. I had one more question just in terms of, in the past, we've spoken about, that HUL has been consistently gaining market share for at least 75% of its portfolio. So does that mean now that, the company has already given much better than expectation volume growth coming in this time around? So higher volume growth, high single digit volume growth, like 8-9% is what we could expect coming in for the company?
Yeah. First, Winnie, thank you for the question, but we don't give guidance. And when you look at quarter-on-quarter numbers, the two, you also have to look at the base effect. And then only you can come to a conclusion of what the underlying numbers would be. And as far as we are concerned, the broad two imperatives, that's what we will be relentlessly focusing. One is to keep improving the consumer franchise, and the second is protecting our business model. And that's our endeavor that would be there. And you've seen us playing this game, not just for the 1 year or 2 years. We've been playing this game for the last 9-10 years and with pretty good success. So I remain very confident. One is the India macro story. Yeah, while there might be, because of the total, stress, what's happening in the economy, but we are a firm believer that this is going to be India's decade, not only this decade and beyond. So the macro story, that does not really change looking forward. And the second, I'm very confident about HUL's capabilities, the kind of brands we have, the kind of talent we have, and the kind of capabilities we have developed in the business.
Right,
Thank
sir.
you, Sanjiv. Yeah, Nupur, do you have any question? Yeah. Okay, we have time for one final question.
Could I go for one more then? We need
Yes,
this side from
please.
Etina. Okay, sir, I just wanted to understand one more thing. Sanjeev, sir, you had, spoken about when you'd spoken to ET now last about bridge packaging, and, that is again coming back as a trend because of the inflation that we've seen in. I just want to understand, is that something that is going to continue for some time, or, given that maybe some decrease coming in commodity prices, maybe that could start easing off, or bridge packaging is here to stay now, and overall in terms of rural demand coming in from there as well?
Vinny, the inflation hasn't gone away from the system. Yeah, and as Ritesh was explaining, there is also a factor called the rupee depreciating, which has an impact on the increase in the commodity, increase in the input cost for us. And during this period, we always look at how do we create more value for the consumers in a very tough context. So the bridge pack is one way of improving the price value equation. And certainly our endeavor to boost the bridge packs and create more price value for the consumers is that equation that is certainly going to continue.
Okay, Sanjeev sir, Ritesh sir, thank you so much for giving me this
Thank you.
opportunity.
Thank you, sir.
Thank you. Nupur, are you back? If you are there, would you like to ask the final question? No, she is again dropped off. Thank you very much. Thank you, everyone, for joining us.
Thank you.
Thank you, everyone.
Thank you.